All right, let's dive right into a really fascinating financial puzzle. It's all about one of Portugal's biggest companies, Sonae. And the mystery? Well, we're going to figure out why a company with this huge portfolio of assets seems to be on sale for way less than what it's actually worth.
Okay, so take a look at this. It really lays out the whole mystery in one chart. On paper, if you add up everything Sonae owns, you get a value of over 5 billion euros. But then you look at what the stock market is saying, and it's valuing the entire company at just 3.6 billion. That's a massive difference. We're talking more than €1 billion that seem to have just vanished. We've got to figure this out.
So yeah, that's the billion-euro gap, and that is the puzzle we're going to solve together today. You can think of this as a bit of an investment detective story. We're going to look at the clues, piece them together, and really understand why this huge discrepancy is even a thing.
Okay, first things first, before we can understand the discount, we have to understand the value, right? So to get a handle on that 5 billion euro number, let's crack open the box and see what's actually inside this Sonae empire.
You see, Sonae isn't just one single business. No, it's what we call a conglomerate, which, is really just a fancy way of saying it's a collection of a bunch of different powerful companies all under one roof. We're talking everything from Portugal's biggest supermarket chain all the way to a huge player in the Nordic pet care market. It's a lot.
Okay, so the absolute crown jewel of the empire has got to be Sonae MC, which is the company behind the Continente supermarkets. I mean, this isn't just a food retailer in Portugal, it's the food retailer. They command almost 40% of the entire market. Add in over 10 million loyalty members and really strong sales growth, and you've got a seriously powerful and consistent cash engine for the whole group.
And it doesn't stop with groceries, not even close. The whole empire is just incredibly diverse. You've got Wharton, a leader in electronics that's expanding its repair shops. Then there's Musty, a massive pet care business up in the Nordics, and Sonae Sierra, which manages a huge portfolio of shopping centers. It's really all over the map, in a good way. And if all that wasn't enough, on top of everything, they also own a huge piece, 37.4% to be exact, of NOS. Now, NOS is one of Portugal's top telecom companies. Think about it. Telecom is a super stable defensive business. People always pay their phone and internet bills, right? So this adds a really solid cash-generating asset to an already impressive portfolio.
Okay, so let's recap. We've seen the assets, and they are valuable. The portfolio is strong, it's diverse, it's full of market leaders. So that brings us right back to our mystery. Where is that missing billion euros coming from? Let's solve this. All right, clue number one. It's a concept called net asset value, or NAV for short. It sounds complicated, but it's really not. All it means is, what's the total value of all the company's individual pieces? You know, the Continente part, the Wharton part, their stake in NOS. What would you get if you sold each one off separately? That's why people often call it the sum of the parts.
And that concept, NAV, leads us straight to the solution. It's a really common thing in finance called the holding company discount. The slide has a great analogy here, the toolbox. The market is basically saying, hey, all those individual tools in the toolbox, they're super valuable, but we're just not willing to pay full price for the entire toolbox when it's all bundled together like this.
And here's where it gets really tangible. Let's break it down on a per-share basis. The actual underlying value of everything Sonae owns is about €2.62 for every single share. But the market, it's only willing to pay about €1.86 for that exact same share. That gap, right there, that is the discount in action.
So you might be asking, why? Why does the market do this? Well, there are actually a few pretty logical reasons. For one, you've got the costs of running the big parent company itself. Then, the Portuguese stock market. It's just smaller. Not as many shares trade hands every day. You also have fewer financial analysts covering the company in detail, so it's a bit under the radar. And finally, some investors just see it as being too focused on just one country, Portugal.
Okay, so now we get it. We understand the discount and why it exists. So that brings us to the next big question. What happens next? And for that, we need to explore the two competing stories for Sonae's future. The bull case versus the bear case. The optimists versus the pessimists.
And really, it all boils down to this one central debate. You've got the bulls on one side, and they believe that this gap, the difference between the stock price and what the assets are actually worth, is going to shrink. But on the other side, you've got the bears, and they think, no way, that gap could actually get even wider.
So the bull case, the optimistic view, is pretty straightforward.
is that strong, consistent results will just eventually win the market over. If Continente keeps growing like it has, if the new musty pet care business turns out to be a home run, and if management keeps raising that dividend, which, by the way, they've done for 9 years straight, then sooner or later, investors are going to have to wake up and close that valuation gap.
But then there's the bear case, the more cautious view. And the argument here is that when the global economy gets a little shaky, investors get scared. And when they get scared, they tend to run away from anything that looks complex. They might sell a holding company like Sonae, which would actually make the discount bigger. Plus, more competition in the grocery market, or a stumble in one of their businesses. That could also be enough to spook investors.
So we've looked at the assets, we've figured out the discount, and we've heard both sides of the argument. So what's the big takeaway? What's the final chapter of this financial detective story?
Well, Sonae's story is just a perfect textbook example of this whole idea. It really shows how the market can sometimes punish a company just for being complex, giving it this permanent discount even when the company itself is made up of fantastic, high-quality, market-leading businesses. And you have to see it from management's perspective. Throughout the company's long history, they've focused on the one thing they can actually control, growing the fundamental value of their assets. Their net asset value grew by an impressive 15% last year alone, and they've been consistently growing their dividend. They do all that while the market's price just bounces around based on sentiment. And this really brings us to the most important lesson of all, and it's a lesson that goes way beyond just this one company. Price is just what you pay. It's a number on a screen, what the market is feeling today. But value is what you get. It's what the business is fundamentally worth deep down over the long haul. And those two things can be completely different.
So, as we wrap up this deep dive into the Sonae puzzle, I want to leave you with one final thought to chew on. So the next time you see a price for anything, whether it's a company's stock, a house, a car, are you going to ask yourself what the real value is? Because now you know there's a difference. And understanding that gap, that potential difference between price and value, well, that's the first step to becoming a much smarter observer of any business.